Uh-huh.
And the data, the actual numbers, are screaming something completely different. Today, that misalignment is, it's so big, it almost feels unreal.
It's a pretty wild scenario. We're diving into a really comprehensive financial analysis report on a company called Webull.
Yeah.
It trades on NASDAQ, ticker is BUL.
Right.
And our whole mission today is to, really unpack the aggressive bull case that this report lays out.
And aggressive is the right word. We're talking about analysts predicting a potential 100% upside. You've got this stock, BULL, trading right now near its all-time lows, around what, $8.65?
Yeah, about $8.65. But then you look at the consensus target from the analysts in this source material, and they're calling for a range between $16.50 and $18.
It's a massive gap.
It is. So think about that. You have a company that the market has just beaten down, is basically on the floor. But at the same time, professionals are looking at it and saying, it could double.
So the big question for you, the person listening, and really the focus of this whole deep dive is, how can a company with this kind of growth, with solid financials, be valued so low? We really need to get into the numbers and maybe just as important, the psychology behind this disconnect.
Yeah, that's the paradox we have to tackle right away. The stock is at $8.65, which, that usually signals some kind of deep, deep trouble.
Failure, basically.
Right, operational failure. But then you look at the financials. And that story just falls apart. It doesn't hold up.
So then why? Why is the stock there? The analysis report seems to suggest it's a case of the market's memory just overriding what's happening right now.
That's the heart of it. The market is still totally hung up on the fact that this company went public via a SPAC.
The broken SPAC narrative.
Exactly.
Yeah.
For anyone who doesn't know, a SPAC is it's a faster way to get a private company onto the public markets.
Yeah.
But a lot of them, once the initial excitement wore off, they just collapsed.
Or traded sideways forever.
Yep. And the market has been treating BLL just like one of those failed projects. It's a case of guilt by association.
I get the skepticism, I do, but $8.65 feels like the price for a company that's actively on fire, regardless of how it got listed. Doesn't the market usually punish that kind of volatility, even if the fundamentals get better later on?
It absolutely does, and that's exactly why the report says this opportunity even exists.
Yeah.
But it points to their Q3 earnings as the moment everything changed. The moment that old narrative should have died.
And they called that quarter a monster quarter.
They did, emphatically.
Yeah.
We're not just talking about, a slight beat. We're talking about a fundamental shift in the business.
Okay, so what was so dramatic? What are the numbers that are supposed to change everyone's mind?
Two things jump right out. First, 55% year-over-year revenue growth. And second, and this is the big one, they actually hit profitability.
Okay.
And that's the line in the sand. That's what separates a speculative bet from a real viable business. The report is basically arguing that the market is just completely ignoring that milestone.
So the opportunity here is because the business is acting like a high-growth fintech, but the stock is priced like a failed penny stock. It's like finding a brand new sports car engine being sold for scrap metal prices.
That is a perfect way to put it.
Right.
The market is pricing the history, the SPAC label. The analysts are pricing the current performance and where it's headed. This whole $18 thesis is built on the idea that sooner or later, the market has to correct that mistake.
All right, let's pivot then and really dig into these fundamental catalysts. It's obviously more than just one good quarter. The first big one you mentioned is this idea of hypergrowth in a slow market.
Yeah, context is everything here. You have to look at their competitors, other brokerages, other financial services companies. They're struggling right now. I mean, you're lucky if you see low single-digit growth from some of the big established players. Maybe low double digits. Growth is really hard to come by.
And Webull is doing what again?
They reported $156.9 million in quarterly revenue.
Okay.
You measure that against last year, and it's a 55% year-over-year jump. That's not just good, it's a complete outlier. It shows they're grabbing market share like crazy.
What's fueling that? I mean, if the U.S. market is slowing down, where is all this new business coming from?
It's all about their global expansion.
Yeah.
This is key. The report really hammers home that Webull is not just a trading app anymore. They're positioning themselves as a global financial machine.
And the report mentioned Latin America and the APAC region specifically. Why are those places so important for a company like this right now?
Because the U.S. market is, pretty saturated. To keep growing at 55%, you have to go where the growth is. Latin America, the Asia-Pacific region, you're talking about huge populations of younger, digitally native people who are just now getting into financial markets.
And untapped markets.
Exactly. They're building a runway for growth that could last for years, which makes that 55% look less like a one-off and more like their new normal.
That sets up the second catalyst perfectly, and it's arguably the more important one, the profitability pivot. Tell us why going from losing money to making money is such a game changer.
Well, if you think back over the last few years of tech stocks, especially the ones that came out during that boom time, The story was always growth at any cost, grow revenue, but lose hundreds of millions of dollars every quarter doing it.
And for a while, the market was fine with that, but then it wasn't.
Exactly. The mood shifted. Suddenly, the market wanted efficiency. It wanted a path to actually making money.
Yeah.
And the companies stuck in that growth but losses cycle got crushed. That's why this Q3 result for Webull is such a huge deal.
So what was the actual net income figure?
Q3 net income was $21.7 million.
Wow.
That's massive. It means the company isn't burning through cash anymore to grow. It's self-sustaining. The report says they're printing cash, not burning it.
So here's the so what moment then. Why does $21 million in profit matter more for the stock price than, say, $156 million in revenue?
It comes down to who can buy the stock.
What do you mean?
Big money. I'm talking about pension funds, mutual funds. A lot of these huge institutions have rules, mandates, that literally stop them from buying stock in companies that aren't profitable.
So it's a non-starter for them.
A total non-starter. A company losing money is just too speculative. But the second Webull posted that profit, they moved out of the speculation bucket and into the real investment category.
So profitability is literally the key that unlocks a whole new universe of potential buyers.
Precisely. And once those institutional floodgates open and those big funds start to build positions, the buying pressure is totally different. It's not just retail traders anymore. It's huge, sustained buying. That's what drives the stock toward those higher targets.
Okay, let's shift from the raw numbers to how the market actually values a company. Let's talk about this valuation gap. The report says Webull is trading at a price-to-sales ratio, a PS ratio of about 8x.
And just to clarify for everyone, the PS ratio just tells you how much you're paying for every dollar of a company's sales. So 8 times revenue. It might sound like a lot on its own, but with growth stocks, you have to compare it to its peers.
And what's the comparison the analysts are making?
They point right at a competitor like Robinhood, ticker 8hood. During its own high growth phase, even before it was consistently profitable, it was trading at PS multiples much, much higher than 8x.
So the argument for the $18 target is really just math.
It's basically a valuation arbitrage play.
Yeah.
The analysts are saying, look, if the market just wakes up and values BUL like other profitable high-growth fintech companies,
And the stock has to go up.
mathematically, it has to move into that $15 to $16 range just to be in line with its peers. That alone gets you most of the way to the target. The current price is being held down by that old SPAC baggage we talked about.
Which brings us to the analyst consensus. A strong buy. But I have to ask, are we just supposed to ignore that this stock was once trading at $79? Even if the crash was structural, a 90% drop is still a massive red flag for any serious investor.
That's a very fair question, and the analysts tackle that head on. They make a distinction between a structural collapse and a fundamental collapse. The fall from $79, they argue, was all about the mechanics of the SPAC deal.
Meaning what exactly?
Things like lockup periods expiring, a flood of new shares hitting a market all at once, and institutions selling shares that they had planned to sell from day one, no matter what the company was doing.
So it was forced selling. It had nothing to do with the company's actual performance.
That's the argument. They believe that whole messy process is finally over. The dust has settled, as they put it. And what's left is a strong, profitable company that's just, well, it's deeply oversold. That $79 high was pure hype, and the $865 low is pure mechanics. Neither one reflects the reality today.
Let's get into the specific price targets, because the range itself is pretty telling.
It is. Even the most conservative analyst is bullish. The lowest target in the report is $12, which is still, what, a 38% gain from where it is now?
And the average target, the one that gives us that near 100% upside.
The average target is $16.50, which gets you about a 90% return. That's the number that the valuation math, the PS re-rating, really supports. And then you have the high-end target for the Super Bowls, which is a staggering $22.
Over 150% upside. Okay. So the fundamentals are there, but timing is everything. Fundamentals give you a reason to buy, but technicals, the charts, tell you when. What does the chart look like?
The technical setup actually seems to confirm the fundamental story. The chart is showing a pattern called a double bottom.
Which is a classic reversal signal.
It is. For anyone who looks at charts, it's typically a very bullish sign that the selling pressure might finally be exhausted.
And where is the support level? Where has the stock stopped falling?
There's very clear, very strong support between $7.50 and $8. The stock has gone down to that level multiple times. And it has, as the report says, refused to go lower. That gives you a pretty clear line in the sand for managing risk.
Okay, but holding support is one thing. To really get a run going, you need a breakout. What's the key level it needs to break above?
The immediate level to watch, the pivot point, is $8.75. That was the high from the previous trading day. The analysts say a clean break above that level, and this is important, on high volume.
Great, volume is key.
Volume is absolutely necessary to confirm that the trend is actually reversed, that the buyers are really back in control.
And what happens if it breaks that 80-75 level? What's this volume gap I read about in the report?
That's where it could get really exciting and really fast. Once the stock gets above the $10 mark, there's a huge volume gap on the chart, all the way up to about $14.
And a volume gap means very few shares traded in that range historically.
Exactly. Which means there's not a lot of resistance overhead. There aren't a lot of people who bought in that zone who are now waiting to sell and get their money back.
So it could move through that zone quickly.
Very quickly. If that institutional buying kicks in and it clears $10, the price could accelerate through that whole $10 to $14 range with a lot of velocity, heading straight for those analyst targets.
So let's wrap this up. What does this all mean for you, the person listening? What's the core takeaway from this deep dive?
I think the report makes a really compelling case that the market price at $8.65 is just fundamentally wrong. It's disconnected from the reality of the business.
The 55% growth, the $21.7 million in profit.
Right. Those numbers move Webull out of the realm of speculation and into the world of a fundamental investment, as long as that technical picture confirms it.
And the report's final verdict seems to be that the math works. The math supports that $18 target. And they call this current level a golden entry for a patient investor.
Yes, for an investor who is waiting for that final trigger. Which brings us to the final provocative thought you should be mulling over. If the fundamentals are this strong, if the company is now officially profitable, and the technical setup gets confirmed by breaking that $8.75 pivot point, how quickly can all that new institutional interest overwhelm the old negative SESPAC sentiment and just rocket this stock through that volume gap toward that 1650 analyst target?
The speed of that institutional buying is going to be the deciding factor. We'll definitely be watching the charts.